many years ago when I was in high school. We had an assignment to create this fictitious stock market account. Well, it doesn't have to be the stock market, but it's basically anything like $10,000 of fake virtual money. We had 1 month to do whatever we wanted with that virtual money. Person in the class with the highest return wins some sort of prize. I didn't win anyway. How would you play this exercise out right now? Suppose you had $10,000 of fake money or real money, whatever the case may be, in a 1 month time horizon. What would you do?
Well, that's a very that's gambling. That's gambling,
Pretty
Matthew.
much, yeah. Clem Chambers returns to the show. He is a CEO of online blockchain. We had him on not too long ago calling for higher prices for some of the assets that we're about to talk about today. So, Clem, welcome back. You were right. Bitcoin has continued to grind higher. What is next? We're going to start by asking you this question, Clem. What is your favorite asset right now?
Oh, English stocks. I mean, English stocks are just going vertical, and I love that because I'm English, aren't I? And I, that's one of the things that I know like the back of my hand. So I'm sat there, absolutely coining it. So I couldn't be happier with the UK market, which is on its back. It's had such a terrible time. Everybody's imagining it's going to go extinct. It could happen, but at the moment, its big caps are going, vertical. But then they're valued at something like half price to American stocks of the same quality, a third of the price. And some stocks are like 10% of what an American equivalent would be. So they're all getting bought up and all getting taken over. And everybody's looking for the next one that's going to get taken over. So they're going from utterly pathetically cheap to just ridiculously cheap. But that jump is a big percentage. So I'm very happy.
Right. The FTSE has been lagging the American stock markets for quite some time until maybe recently. What happened?
Oh, lagging the whole world. I mean, it lags Germany just as badly. Now, the only one it doesn't really lag too terribly, but it does poorly lag is the French market. So, it's just really, really hyper lagged everything else. And nobody really understands why. But I mean, basically, they've got this transaction tax. Ooh, transaction tax. And, if your government starts to drain money out of your system with a transaction tax in the market, it's going to hurt it. And that's really one of the major things that's hurt it. But there's a load of other things that have hurt it. Brexit hasn't done it any favors. The way that the market is kind of rather prehistoric in its attitudes hasn't helped it. And I think that, it's just over a generation. It hasn't gone anywhere in 25 years. I mean, really, it's only like 10% higher than it was in 2000. So that gives you an idea. Anybody wants to put a chart of the FTSE against the Nasdaq or the DAX will go, oh, what? That's incredible. It's a dead thing. But at some point, cheap does get so blooming cheap, people start buying it, and I think that's where we are today.
The
So I
markets
like.
are, well, speaking of the UK, the markets are fully pricing in a rate cut from the Bank of England in the next couple of months. Why do we not have similar expectations for the Fed?
Well, I mean, I think the Fed is going to lower prices. I'm sorry, lower interest rates. So that is coming, but they really don't want to get people's expectations high because in the States, if people reckon there's going to be a 1% drop in interest rates, everyone starts saying it's going to be 2%. So the market gets ahead of itself in the US. It's already hot. I mean, equity markets are very, very hot. Inflation isn't high apart from when you're in America and you start spending your money and you go, what happened to prices? I don't recognize them. So we get back to that problem of reported inflation and real inflation. So I guess, they're not putting down interest rates as fast because they don't want to get expectations too high. And maybe inflation, as they measure it, is actually higher than they admit to. So they don't want inflation to, go up or stay high as it is. They want it down. And so, in those instances, you've got to, be careful with what you get in interest rate expectations to. The other thing is the excess money indicator, or what I take as that, which is the reverse repo. That was dropping like a rock, but suddenly it stopped dropping like a rock. So there's this big chunk of excess cash in the market, and it seems to have stabilized. So I take that as as a desire to stabilize the markets up to the election, because you don't want them, going nuts and people in various parts of government taking the blame for messing with the election now, do you? I mean, the Fed doesn't want to be blamed for one party getting in or another party getting in. So right now it's trying to hold things, stable until after November. And I think I've written in many occasions that they will try to keep stability going up to the election. And so I think, one of the things about not dropping interest rates really quickly is that people are going to say, oh, it's trying to is that's pro this side or pro that side or anti that side. So, they are trying to be, very, very low key up until the election, I think, and that will affect the markets accordingly.
Before we continue with the interview, I want to tell you about a great resource for investors, Doug Casey's Crisis Investing newsletter. Doug Casey is the best-selling author of several books, including the New York Times best-selling book Crisis Investing. He's appeared on my show several times and is a fan favorite, which is why I'm delighted he's decided to sponsor today's message. The Crisis Investing newsletter breaks down Doug's views on global affairs and the highest risks for investors to track, often from a higher-level geopolitical perspective. In a recent piece called Can You See It? The End of America is Near, he writes, the signs are everywhere. It's a troubling picture, but one that Americans can no longer afford to ignore. Inflation, open borders, increasing crime, the list goes on. But perhaps the worst situation of all is what's happening with Ukraine. Our world political leaders are sleepwalking us into World War III with Ukraine. If you want to learn more, Doug has agreed to give a 20% discount to viewers of the David Lynn Report. So if you'd like to know how Doug is investing his money, and more importantly, the stocks that he's recommending, secure a 20% discount today by subscribing to the Crisis Investing newsletter. Just go to crisisinvesting.com/David Lynn, scan the QR code here, or click on the link down below. Well, okay, so let's take a look at what the futures curve is pricing in. So as of right now, the 3rd of June, Monday, there is a 99.9% chance that there will be no cut by the June meeting, which is in 9 days. All right, July meeting, 85% chance, no change. September meeting, 51% chance of a cut. Yeah, so there's a 50% chance of a cut by September is what the markets are pricing in currently. We'll see what Jerome Powell and the Board of Governors announces on the 12th of June. That may or may not change things. Let's assess the inflation situation in the United States, Clem, because that will impact what the Fed does over the course of the next couple of months. So like I pointed out to some of my other guests last week, Walgreens has announced, one of the retailers, the largest retailers in the United States, Clem, has announced price cuts across more than 1,000 locations. Amazon 2 weeks ago announced price cuts on their grocery store items by up to 30% online and in their brick and mortar locations. This follows as Target has announced something similar. Big box stores are cutting prices on grocery items. Why are they doing this, Clem?
Well, competition, right? I mean, one thing that I see out in the world economy right now is that there's a sort of sudden grinding of gears. So after COVID, a lot of people had a bit of spare money because they've been sat around not spending. And then they went out and spent. So there was a lot of kind of revenge spending. But now reality is kind of catching up. So now you're starting to feel a little bit of a wind of recession out there in certain areas. People are starting to feel the pinch now. So, I mean, I see that in Europe. There's still a lot of what they call revenge tourism going on. So tourism is very, very busy. But on the ground, the employment market isn't as strong as it was. After all, it's blisteringly hot for a time. And now all of a sudden, there aren't jobs going, begging. So there's a kind of recessionary air out there. Well, if you're in the business of selling groceries, you're going to, want to compete into that by cutting prices, because that's kind of advertising, isn't it? Oh, we're cutting prices on 1,000 lines and all that good stuff. And you're advertising to people to come along, we're cheaper. And in Europe, we've seen a lot of success with supermarkets that basically market themselves, like the good old days, as being the cheapest. So I think you're seeing that. You're seeing a lot of people starting to feel the pinch, starting to get careful with their spending, and that's feeding through into retail, and retailers responding. I mean, you could call it disinflationary moves. I mean, actually, that's a deflationary move if your goods are coming down. But I don't think we're going to be seeing deflation. I mean, that deflation, well, that's an easy one to fix. You just print more money like they did in the first place to create inflation. I mean, deflation, inflation, if you want to get rid of deflation, you print money. That's it. Always has been. if you've got a level of inflation that's very low and it's there, it's because they want it there. Remember, the only people that can create inflation are governments. Nobody else can create inflation. It's only done by governments. And the same goes with deflation. It's only created because governments want it. Now, they don't go, oh, yes, well, we want high inflation now because this, that, and the other. They go, oh, no, it wasn't us. We didn't do it. Oh, and then when it goes into deflation, they say, no, it's not us. We wouldn't. How can you get inflation? Oh, we can't manage to do that. They can do it in Venezuela easy enough. They can do it in Argentina easy enough. Funnily enough, in Japan, they can't do it. Oh, no, can't do it. Oh, no.
Well, shipping rates in the Red Sea are going up, are spiking up again, Clem. That has nothing to do with monetary policy. Do you think that, which obviously is a response to what's going on in the war in the Middle East, is going to push up inflation, at least for Europe?
Yeah, I mean, you get blips of inflation and prices go up. There's a harvest problem in some countries, so the price of rice goes up, etc. But you get counteracting forces, and these trouble in the Middle East and all that good stuff. We've always had that. We will always have that, and inflation will go up and down in the main, not because of some oil shock in the Middle East, but because of money printing. And when these governments are running these big deficits, they have to print the money. That money ain't coming from anywhere. They've taxed everybody up to the eyeballs. They can't get any more money from tax. So they just have to print the money. And then they say, oh, it wasn't us. We didn't do it. Yeah, you print more money supply, you get inflation. That's how it always works. That's why they do it in South America. That's why they do it in all those countries which run deficits or where they can't tax their population. They just print it. Right. And that's what creates inflation. And of course, they don't own up to it. Oh, no. Yeah, that was us. Yeah, we did that. We caused 11% inflation. Yeah, that was us. Oh, I'm sorry about that. But we wanted to do it. So we did it.
What did the
Yeah, they
Bank of
never say
England
that.
what did the Bank of England do to bring it back from 11% to 2%?
Well, there's two ways you do it. But the main way is that you do QT, is
Hmm.
that you start, pushing your bonds out there and sucking up the cash. Well, when you print bonds and you send it out into your country and you say, give us your cash, we give you some interest rates now. Yeah, that money ain't getting spent. So the money supply goes down. In effect, is that it's locked up. Because if you've got a bond, you don't go down the local pub and say, can I tear a corner off this bond, please, and buy a pint of beer? You just haven't got any cash. You don't buy beer. Price of beer doesn't go up. So that's the simple way. That's QT, which America's been doing, but they had such a massive oversupply of money. It's taken a long time to get it down. You could get it down really quickly, but then you crash your economy and then you get systemic failure and then you get your banks folding and you're back in 2008. So you don't want that. So you have to ease it down. And meanwhile, you don't say, oh, we're doing this because we did that. They just say, it wasn't us. We didn't do it. Someone else. It's over there. It's those guys over there. It's not us. Oh, it's the Middle East. Oh, it's the Red Sea. Oh, it's crop failure somewhere. And everybody else gets blamed for what they've done.
Here's the question I get asked a lot. So since we're talking about the UK, like I said, it's expected the Bank of England, along with the ECB, are going to cut rates this summer. Will this reignite inflation, Clem?
There's lags. Yeah. So they can cut interest rates. Won't actually make any difference if they cut interest rates. They can increase money supply or decrease money supply. Now, if they increase money supply, there will be not much inflation up until a certain point where they increase money supply beyond a certain barrier. It's a sort of takeoff zone. So you can increase money supply 2 or 3 or 4% every year, and your economic growth takes up the slack. But if you just print lots and lots of money and then pump that into the economy, you get inflation. Good old fashioned 1970s. I've got a big budget deficit. I have to print the money. Don't care where it goes. That's when you get inflation. So if you've got a big problem or a big deficit, or you've come out of a war and you just can't make your payroll, government payroll, just got to print confetti and hand it out, then you get inflation. So if you produce monetary growth that goes beyond the supply of goods, then you get inflation. So they can increase money supply and not create inflation, but it's a very, it's a very difficult balance, which is why they used to be deflation because they used to be too conservative with making money supply, and therefore inflation ran at too low a level because they're really scared about producing too much and then having a takeoff in inflation and being, all over the news for their inflation being back.
Well,
But
to
I
my understanding,
think,
yeah,
go on.
sorry. To my understanding, at least in the U.S., the Federal Reserve, I'm not sure about England, but the Federal Reserve has not issued or made any statements regarding their plans to re-engage QE. So, will that change anytime soon? Is there an incentive for central banks now to reignite money printing at some point?
Well, the Fed is bringing down its balance sheet, okay, which can be considered to be QT. And a
Yeah.
load of
So
people have
that's the
been
reverse of QE. Yeah. So yes.
That's right. And a load of people have been complaining. I think Dimon came out and said, oh, this QT is a bit tricky. Or, but if you want to look at excess money in the system, you look at the reverse repo, which is where the banks stick their cash, which they can't use, which got into the system in the first place because the government printed it. Now, that has stopped coming down. Now, you could say that is because the economy is retrenching and business and industry doesn't want to borrow the money, and therefore there's no demand at the banks to get their hands on that money, which seems like a possibility, but slightly unlikely. So if it's not the economy slowing down, if it's not people demanding to borrow less money, it's because someone else is putting another lever and twisting another knob and pushing money into the economy another way that isn't QE. Now, you can't tell me that they don't have all sorts of ways of getting money into the system that isn't QE. I mean, there's twisting and all that stuff. So one thing they have to do is while they're doing QT, they're QT a part of the bond curve, which means there's still a lot of short-term money sloshing about, but long-term assets are doing the job. So who knows what they're up to? All I can see is their reverse repo is not going down. So that lump of money that's not going down is excess money, which is likely to be causing inflation. So there it is. You can look at it. They update it every week, and there it is, reverse repo. And you can look at that alongside the balance sheet and see how they was all coming down like a brick. And all of a sudden, the reverse repo stopped going down, and there's this excess money is constant in the market. So that's quite interesting. So the new thing to bear in mind, it's not about interest rates. It's about the availability of money. Because if interest rates go up, the only people that get hit are people on fixed borrowings like mortgage holders. So that has a drag effect. But if any old fool can go out and borrow money at 6%, you'd get a lot of inflation because a lot of people want to borrow at 6%, but simply can't do it. And conversely, if you had 1% interest rates out there, everyone could borrow at 1%. But, oh, sadly, there's no money to be borrowed. Yeah. You'd have absolute, wipeout because it doesn't matter what the interest rates is. It's the availability of money that is key. And that's what all the central banks have been doing over the last few years is making money very available. And it got to such an extent because of COVID, that availability has caused inflation. And here we are, they're reining in the availability at a pace where they don't break the system, which they're there to look after.
There's this thing called the Trueflation Index in the U.S. It's this a private indicator that basically tracks inflation supposedly in more real time, using more real time data than what the BLS reports, which is lagging by always a month. 2.2% is the latest reading on this Trueflation number. What do you make of this, Clem?
Well, it's very interesting because that whole trueflation stuff came out because the inflation was meant to be underreported. So, the true inflation is higher, that everybody was saying. So they came out to show what it really was, that it would be higher. But what they're measuring, it says it's lower. And well, okay, that's interesting. But does anybody out there feel that the true inflation rate is actually lower than the one that is being reported? I certainly don't. So I get cognitive dissonance with that. I mean, I spoke to those people a few years ago, and I thought, oh, that's interesting. Yeah, yeah. And then suddenly they're reporting much lower inflation than what the governments are reporting. Oh, because we're going into recession, depression, and all that stuff, de-inflation. But I don't. My gut, which obviously is connected to one part of my anatomy, which I don't like to talk out of, says that inflation is actually higher than the reported numbers, not lower. So I don't know, make of that as you will.
I guess it really depends on your consumption patterns. So certain things have been deflating, certain things are going up more than others. Sure. Generally speaking, then, I'm talking about the overall CPI index. What is your feel? What is your guts, if you want to use that term, tell you what's going to be for the remainder of the year? Because ultimately that will affect monetary policy.
Higher for longer, but not so high as it's been. Okay, so my starting point is inflation is not accidental. Okay, after every war, there's always massive inflation, and COVID was kind of like a little war. Yeah. So the inflation that followed follows a historical pattern of disaster followed by inflation. And you could just look at the history books and see it all around the world forever. Okay. So the governments have got these huge deficits, which are basically very difficult to kind of keep under control. And they haven't got them under control. And it requires the only way you can really get them under control is to inflate them away. Now, you can't inflate them away too fast, otherwise, the wheels come off and everybody suffers horribly. But you still need a certain amount of inflation 3, 4, 5%. So that's what we're going to get. We're going to get a elevated level of inflation. And the purpose of that will be to increase the tax take, A, increase the nominal, i.e., the number of GDP growth. Yeah. So, and companies, it keeps the economy fluid. It keeps the pressure on people to get out there and make money and be economically active. Because if they're passive, they're going to have all their money just eroded away. So inflation's always been an accelerator, which is why it's always been popular. But too much of it is kind of lethal. It's a drug. But they're going to be trying to take that medicine as far as their borrowings go, and it's going to be more elevated than it was before. So rather than this 2 to 2.5% inflation rate as being the limit, it will be in reality 3.5, 4%. So it will be higher for longer. But interest rates will come down because they're going to have negative real interest rates to dig out themselves out of these deficits. Well, these debts, not rather than deficits. And so that's what you're going to see because inflation is a cure for debt, and they've got buckets of it, and they got the debt and they control the inflation. So there'll be their natural tendency to try to eat away at their overloaded debt with inflation, but not too much just to spoil the picture. And that will be 3, 4, 4.5% inflation, real proper inflation.
If you think the Fed is going to cut rates sometime this year, what's going to happen to Treasury rates, the 10-year, 30-year? Will they also come down along with the Fed funds rate?
Well, I don't think anything dramatic is going to happen as far as the levers of the American economy until it's close enough or past the election. No one's going to. I mean, what's the hue and cry out there in the headlines at the moment? Inflation interference. Oh, foreign countries interfere in American election. Oh, this party's interfered with the American election. Oh, those guys have interfered with the American election. Everybody's interfering in the election. The Fed is not going to put itself in front of that cannon, is it? They're not going to. Nobody, who's got public policy that's meant to be neutral is going to do anything that isn't neutral until after the election. Otherwise, they're just going to be pilloried for the rest of the time as the people that interfered with the election.
Wait, sorry, what are you saying? Are you saying they're unlikely to change their rates before the election?
Unlikely to do anything radical,
Okay.
anything that would invite criticism on the basis of it influencing the election.
Okay.
So
But
the simple idea is, I run the I don't know the Department of Chickens in the American government. I'm not going to do anything that might get the newspapers saying I interfered with the election and one side lost because I did something with my Department of Chickens.
right, are you bullish yields then? I mean, in the sense that you think yields will come down and bonds will go up.
Well, what I'm saying is nothing much is going to change dramatically until the election. And then it will get back on a course which it should have been on all along. So if interest rates should have come down a bit more before November, that will happen after November. So basically, anybody who's going to do anything to cause a headline that might be interpreted as interfering with the November election is not going to do anything until after the election.
Tell us more about this inflation interference. What is that? What exactly is that supposed to mean? Who's doing
Well,
the interference here? Yeah.
what I mean is interest rates,
Right.
yeah, are are set obviously, and if let's just say there was they dropped interest rates by 2%,
Okay.
yeah, then if one party got in, if the Democrats got in, everyone would say, well, the Fed's on the side of the Democrats. They dropped it. They dropped interest rates to make the economy seem good, and they've just fixed the election. So they're not gonna do that, are they? They're not going to do anything that will get a headline that says they have influenced the election through their actions before the election.
Yeah, no, that makes sort of sense. Yeah, I understand your logic there.
So
I want
so the old logic used to be that in the first 2 years of a new administration, they would crash the economy, and then they blame it on the previous guys. And then they would have a boom in the last 2 years, which was paid for by the crash of the first 2 years. So they could say, look what we've done with the economy. So that was the election cycle coupled with the economic cycle. Yeah. And everybody would write, oh, there's a new president coming in. We're going to see 2 bad years now and then 2 good years. So get ready for that. Now, this time around, with the American political system, is such an incredible mess. Nobody is going to put their head on that block and put themselves in a position of being criticized for influencing the election by their policy. So the Fed is not going to do anything at all radical, and therefore you're not going to see any big moves between now and November.
Let's talk about one of your articles for Forbes. Commodities are back. How oil, copper, and gold are repeating the wild 1970s market swings. So you wrote that before crypto was a thing, the hottest game in town was commodities. You can lever up to the moon, you can still, and you still can, and those commodities could spike in a way that these days you can expect from a meme coin. Okay. Uh, that was the case with commodities, famous for wild swings and wild market behavior caused by everything from the four horsemen of the apocalypse to market manipulation. The 1970s was a special time for commodities, and you're saying now that's back?
Yeah, I think that's right. It's not quite as wild because remember that was all kicked off by a 400% increase in the price of oil. So that was, and they'd had a lot of inflation before that, and then
Mhm.
inflation went wild. So wild inflation causes commodity spikes. Now, what happens is there's a very big element of FOMO, fear of missing out in commodities. So when they start to move, everybody piles in and they go exponential and they go up, huge percentages, and then they come crashing down. And we've been seeing that. We saw that in cocoa recently. And cocoa was a classic 70s, a moon, as they would call it these days. Yeah. And copper's been doing it. And that's another classic 70s moon. So basically, what happens is everybody starts to look at commodities, starts looking for the next one, and it becomes a cycle of these moons and crashes. And we are already, well, not well, but, into that process of commodities suddenly spiking, there being a vicious circle of price increases, which sends them, vertical, and then they come crashing down when basically it's impossible to do what you do with those commodities at those prices, and then down they come. So that was a whole wave from like 73 up to about 78. So 5 years of it, basically caused by inflation. And here we are back again in a very similar environment, almost an echo of the 70s, and off of the commodities are going. And so you name any commodity, it will do that. It's just a question of when it does it. Yeah. So it'll be pork bellies. Do they still do pork bellies? It's bacon. It can be orange juice. It can be potatoes. It can, you name it. It can be that thing that does that meme coin action. It's very similar to meme coins in many ways because there's all these people watching it and they can lever up to their ears, and it's an exciting game and there's access to it as a highly speculative market. And then after that period in the 70s, commodities basically became as dead as a dodo for a whole generation. But here we are, it started again. So it's the same old story again. What's I say, history doesn't rhyme, doesn't repeat itself, but it rhymes. It's a rhyme, commodity rhyme that we're having again. So anybody that loves to speculate, loves to go for those big rises, loves to trade, the commodities are something that they should be watching because it is already into that sequence of maybe a couple of more years of it, of a obscure or not so obscure commodity suddenly going up 100%
Well,
or
you don't mean
200%.
you don't mean all commodities, right? We don't expect that
They'll
from
all do
gold.
it.
Really?
They'll,
Okay.
they'll all do it. That in the past they all did it. So why would it stop? Because what happens is nobody cares about pork bellies. Yeah. And then inflation catches up with the market because the pig feed goes up and the slaughterhouses charge more and the trucks cost a bit more. So suddenly the price of pork belly starts to go up. And then suddenly everyone piles in and it does the vertical. And then they go, well, I mean, bacon's gone up a lot. No one's buying it anymore. And down it comes, it crashes down. Like we saw with chocolate, cocoa, only a few weeks ago. Up like a rocket, down like a rock. Now, if you can catch the rocket and get off before it starts, well, before it comes down like a rock, you can make a lot of money. So for the speculator, which is one of the reasons why it does this, the speculator's watching that going, oh, what's the next one?
Yeah.
And there will be a next one.
Uh, which commodities do you? Well, okay, I'll end here, and I have another question for you. Which commodities do you favor right now, if any?
Well, I mean, I'm not a big fan of speculating like that because you can lose your shirt very easily. But you can say generally there won't be many commodities that will miss out. They'll all do it because it becomes a fashion. It's a theme. It's just a market that suddenly gets people's attention, and all the speculators move in, and away it goes. I like the precious metals. I think that their time has come. Now, I'm not one of those gold bugs that thinks it's going to go to $100,000. But I do think there's a good, rise through the 2000s coming, and obviously silver will be good too. And I hold a candle for, this is very contrarian, but I hold a candle for platinum because the thing about platinum is they don't make any of it. I mean, you're talking about, in fact, I'm going to have to go off and look up the exact amount of tons they do every year because it's so small. Every time I want to say it, I think it can't be that little. But it's like it might not even, it might be less than 1,000 tons a year of new platinum. I think it's actually 100 or 200. It's a tiny amount. And when you think of platinum and what it stands for and what it does and all the applications for it in industry and in environmental technology, that's a very small amount. So it doesn't take much for the yearly production of platinum to be swept up. So I hold a candle for platinum because it every time I see how little of it they make every year, I go, that's incredible. That's such a tiny amount.
I'm reminded, I don't think I've ever asked this question to anybody before. I think you're the first. So I was just reminded of many years ago when I was in high school. We had an assignment to create this fictitious stock market account. Well, it doesn't have to be the stock market, but it's basically anything like $10,000 of fake virtual money. We had 1 month to do whatever we wanted with that virtual money. Person in the class with the highest return wins some sort of prize. I didn't win anyway. I knew nothing about anything at the time. I consulted one of my mom's friends who was a stockbroker, and I asked him, what should I do? And he said, well, you only have a 1 month time horizon, so you probably need to pick something pretty volatile, right? Because you're going to, it's either win or lose. So pick something volatile. And he suggested just lever up on oil. I think that's what I did. I don't think I did very well. Anyway, how would you play this exercise out right now? Suppose you had $10,000 of fake money or real money, whatever the case may be, in a 1 month time horizon. What would you do?
Well, that's gambling. That's gambling.
Pretty much, yeah.
If you want to go gamble, you want to go and put it on Ethereum because in the next 30 days, there's going to be an ETF near enough. And, if suddenly all the crypto kiddies pile in, it will do well.
Yeah, it's already been approved though, Clem, right? Isn't that going to be priced in already?
Yeah, but I mean, it's just the FOMO aspect of it.
Okay.
I mean, look, if there's another leg on Bitcoin will go to 120. So it's 70 now, so it'll go up, whatever that ratio is, 5/7. And that will be nice. But Ethereum will probably go to 8,000. And that is, well, it's at the top range of 3 now, so it'll double. But, if it kicks off, crypto's going to kick off soon. It's not going to hang about. It's not going to wait till next year. It's going to go sometime this summer. I mean, so if you want to do your Mad Harry lose your shirt trade, I mean, obviously the simplest thing to do is just pick call or put and go stick it on Tesla, and then put your fingers in your ears and kiss your backside goodbye.
You know what the
But
teacher should have done now that I realize it? He should have made a punishment for the loser of the class because that would have incentivized somebody to not do that, what you just said, and actually try to hedge or be reasonable or actually have some sort of risk management, right?
look,
Because there
look,
should be a reward for the classmate with the highest return, but a punishment if you're last place. That would make it interesting. Let me
well,
add
I
that.
mean,
Let me add that factor. You cannot lose all your money in the
that,
next 1 month.
I think it's very simple. Everybody knows how to invest in the stock market properly. It's
Okay.
called buy the S&P spider
Okay.
and go leave it alone and come back 20 years later.
Yeah.
And nobody wants to do that because it's no fun.
Right.
Yeah,
Okay.
what they want to do is they want to double their money in 30 days, which is why you asked that question. And my answer is, well, if you really want to lose it, guaranteed to lose it, do it with options. But if you want to take a poke at something that could go up a lot or not go down too much, it would be Ethereum. But ultimately, people want to have that inverted commas tip. Yeah, they don't want to know the real truth, which is to put it in the S&P 500 and drip however much you can afford every month into that and never look at it again until you retire. And then when you do, you'll go, oh, look at that. I struck a light. How did I make all that money? But nobody wants to know that. A long time ago, I used to do a course on classic investment value, contrarian investment. And I did 3 hours, and everybody said how brilliant it was. They all came to the front to tell me how brilliant that my talk was. And all they asked was, did I have a share tip of something that was going to go up a lot tomorrow?
What is your view on Bitcoin? We'll end it here.
Bitcoin, there's a third chance that we've seen the top. One in three, and two in three, it's going to go to 120,000. So I'm long Ethereum because Bitcoin is going to go, $50,000 a coin up, and Ethereum's going to double. So, the pop is in Ethereum, and also Ethereum's possibly going to go further after Bitcoin's peaked like it did last time. So the momentum in the crypto market will carry on in Ethereum past the Bitcoin top. So, and I can't get excited about all the small juniors and all the crazy stuff anymore because it's all not that exciting. So Ethereum is the only place, as far as it's the only place I am in crypto in any major way. And it's because I think there's a 60% chance that Bitcoin would go to 120,000.
Very good. Where can we follow your work, Clem? Learn more about you.
Follow it on Forbes. I do a bit of Seeking Alpha occasionally. That's the best place to hear my ramblings. And I write fairly regularly, and you'll see it all there in glowing Technicolor.
Well, appreciate bantering with you as always, Clem. Thank you for being here today. We'll see you again soon.
See you soon, David. Bye-bye.
And thank you for watching. Don't forget to follow Clem in the links down below. Make sure to subscribe.
Don't forget to subscribe and like and smash that bell.